My name is Stephen Gokes. I'm the Managing Director of Natgen Group, and today I'm here to introduce to you our Natgen Investment Trust SG25. So the genesis of the SG25 Trust is our long-standing interest in office accommodation, but mainly related to non-CBD office. You will have heard us talking about non-CBD office as one of our core areas for a long time. And we've already brought that to fruition on the Gold Coast and in Gladstone and in Cairns previously. So as the cycle has moved through, we've been ignoring Brisbane for some time, waiting for the cycle to turn, and now we're more comfortable investing in Brisbane. Again, not CBD Brisbane, but near CBD Brisbane. As with all Natgen investments, we are looking for areas that show excellent locational attributes. That can include such things as good infrastructure in the immediate vicinity, economic activity in the vicinity, in other words, a workforce and a reason to be working there. And thirdly, a level of lifestyle that allows for people to maintain there over time. We've found those attributes in this building, which is 38 Southgate Avenue, Cannon Hill. Cannon Hill is an interesting little office enclave, less than 10 kilometres to the east of Brisbane CBD. It's very well served with transport links, which makes it really valuable. So we've got road corridors that take you directly to the M1 motorway running north and south. It's also on a train line, so easy for folk to get to work. Those are the key elements that you need for an area such as this, where you're bringing office workers to a particular place. One of the reasons for the popularity of non-CBD office parks is that connectivity and the ease of people to get there. We found over the years, of course, that when everyone was coming to the centre, the CBD, it was more difficult for people to get there, longer commutes, slower life and less time for leisure and doing your own thing, I guess. And that's probably what led to the work from home push being very strong during COVID. But we're seeing that sort of unwinding now, and more people are going back to the office and recognising the benefits of that, both for the company and also for themselves. One thing that work from home particularly was giving people was a sense of isolation. They weren't getting those informal interactions that happen in an office every day. There were certainly some benefits of work from home, but in terms of understanding what's going on in your organisation, organisational culture, and basically getting to interact with all other levels of your organisation, those things were deficient. 38 Southgate Avenue is a 3-storey office building consisting of around 3,500 square metres of net lettable area on a 2,000 odd square metre site. The site also has 81 car parks, and the building has been built to a high standard just over 10 years ago. I think it was 2012. And the building has achieved a 5-star NABERS energy efficiency rating, which is becoming increasingly important for tenants in fulfilling their ESG obligations, both for government mandates and also for investors in these businesses. Speaking of the tenants in the building, we have 3 national and global tenants in the building. First tenant is Orica, an ASX listed mining services company. It's actually the smallest of the 3 tenants in the building when quoted by market capitalisation, and it's also the one that's going to be there the shortest time. It's actually going to leave the building at the end of 2025. The second tenant, Compass Group, is a London Stock Exchange listed entity which provides food service and catering globally to all sorts of large users such as stadia, mining sites and all those types of things. It's been in the building basically since it was built and has a strong presence within the building. The third tenant in the building is Mindray Medical, which is a global medical instrument manufacturing company. When looking at office assets in Brisbane, it's important to consider the supply and demand cycles and where we sit at the moment. Brisbane has been through a time in the last decade of higher vacancy than usual, and the beauty of property is these things always level themselves out. So what's happened is we've gone through a period of quite stagnant rents and very high incentives in the market. But what's happened in the post-COVID years is that building costs have risen to a great extent, so new supply has been very constricted. In fact, I can't think of one building that's being built in Brisbane at the moment, one office building. So what that's doing is suppressing supply in a time when demand is building. So the time basically from now until the Olympics is a time where we should see expanded economic activity, certainly in Brisbane and southeast Queensland, is one of the reasons we're sticking close to southeast Queensland with a lot of the stuff that we do. So basically, when you've got increased demand, reduced supply, obviously price goes up. So we're seeing the amount of incentives in the market is starting to compress, and that's really valuable going forward because we're buying in the current situation. But a lot of the forecasts for the next 4 to 5 years are for that status quo to continue, so that rental increases should be obvious in the market over that time. As I said, one of the main reasons that is the case is that the cost of developing new office buildings is actually well above what you can lease them out for, what an economically valid rent is. So in that basis, developers don't do it. They just wait until the market dynamics basically normalise. So if you can buy existing assets, and particularly good quality existing assets in that time, then you can see significant increases in value. Because office has been in the doldrums for the last few years, we've also got the fact that it's been a bit on the nose with investors. So that's given us the opportunity to buy this asset at prices that would have been unheard of, say 4 or 5 years ago, and certainly 10 years ago. So, like everything to do with property, it's about location and about timing. So we've ticked the location box, tick, Cannon Hill, we like that, and we believe we've got the timing right. Have we found the very bottom of that market? Well, it must be pretty close. When the pundits and commentators in the sector are starting to talk about green shoots, it's probably a pretty good time to say that you're at or near the bottom, and that's when we like to get in. Because that's how the Natgen investment philosophy works, basically. Buy well, manage the heck out of it, and then sell well. And you can't buy better than at the bottom of the market. One aspect of that differential between high construction costs and basically current assets being at the bottom of the market is that to replace the current assets at the sort of money that we're purchasing them for is impossible. So the replacement cost of the asset is much higher than what we're paying for it. That actually gives you a sort of latent profit that's built into that differential, because construction costs aren't going to come down. So what's going to happen is rents are going to have to increase over time to match up to those replacement costs. And that's where the value growth comes for unit holders in our trust. I've already mentioned the Olympics as an important factor in the growth and demand in Brisbane, but it's certainly not the only factor. Underlying growth over the long term is really things like population growth. And one thing about being in this business in southeast Queensland is we've enjoyed population growth for literally the whole of my career and beforehand. So that's going to continue. The lifestyle opportunities in southeast Queensland have always drawn people here from interstate and to a certain extent overseas. But actually the drift of people in Australia is the migrants tend to come into Sydney and Melbourne, establish themselves there, and then basically drift north to lifestyle areas as they become more affluent over time. And that is what gives Brisbane its long-term competitive advantage. I could talk to you about all the particular stats that are out about forecasts for rental growth over time, but I think it's more important to just understand the basic reasoning behind it and the trends. And really that is about the fact of the growing population, the Olympics, the other aspects of Queensland life that are drawing people here, and also a relatively pro-business environment. I mentioned earlier that Orica is due to vacate the building at the end of 2025. So it's important to understand how we plan to deal with that vacancy and replace it. So Initially, it's important to understand that office vacancy in Brisbane is low and falling. So basically there's more tenant demand than there is supply. That's the best place to be when you're faced with a vacancy. The way we've dealt with it is by negotiating a pretty substantial rental guarantee with the vendor for that space, which gives us time and money in order to replace Orica over the 6 to 12 months following their departure from the building. Other things that are important in our confidence about reletting the building is the quality of the asset itself, the 5-star NABERS rating, and that all-important issue with all property, location. The targeted return for the trust is 8.25% per annum, which we will be paying from the first distribution after settlement. It's important also to understand that we only quote the cash return that we give. So you'll see a lot of our competitors are quoting total returns, which are much higher figures. We've always chosen not to quote total returns because it always relies on assumptions that are very difficult to test. So we prefer to deal with numbers that we can prove and back up, and those are the rentals that we know are coming and basically the costs that we know relate to the property. And if you take those revenues and you take away the costs, that's where you come up with 8.25% per annum. In purchasing the property, we intend to borrow about 50% of the purchase price from a major Australian bank. We have relationships with basically all the big 4 banks, and we will, during the purchase period, go out to each of those banks and basically tender for the best price and terms that we can get on the debt during that time. One thing that's happening in the market just at the moment is interest rates are coming down, and just as they rose more precipitously than anyone expected, they're actually falling more precipitously as well. Maybe we're thanking Donald Trump and tariffs for that at the moment, but it was a trend that was happening even before that. We will take advantage of that and look to undertake interest rate risk management to hedge those interest rates once we've settled the property. Natgen investment trusts generate returns from 3 sources. The first is the cash return, which I mentioned before, which is basically the rental less the costs of providing the building to tenants. The second is the capital appreciation that is likely to happen over time from the factors that I mentioned before, also relating to growth of rentals, to bring the rentals up to closer to replacement cost of the building. And the third is taxation benefits, and this comes from the standard amortisation of building allowances within buildings such as this. All these 3 combine to create really good returns from commercial property, and in particular the one that we state is only the first one of those, which is the cash return. The taxation benefits and the long-term capital value become clear over time. I'm often asked how interest rates impact a Natgen investment trust, and basically it's as you'd expect. Well, there's 2 things. Interest rates impact the income aspect, because the income for the trust, because the rental is generally reasonably fixed, but the costs, including interest, can be variable. So as interest goes up, obviously the costs go up and reduces the net return. We take that into account when we structure a new Natgen trust, and we allow enough working capital to basically smooth out those timing-based issues. Conversely, of course, as interest rates go down, costs go down and net revenues go up. The other aspect of interest rates is basically, as interest rates rise, it pushes up the cap rates of properties, which suppresses their value for a given level of rental return. So the extra good news when interest rates come down is that the capital value of your assets appreciate faster than they would otherwise as well. Interest rates and Natgen's management of interest rates is something I regularly get asked about, and it's something that I would say probably occupies more of my time than anything else, both during the day and between about 2 and 3 a.m. in the morning, when I wake up thinking about interest rates most mornings, sadly. But basically, what we do at Natgen is we have no crystal ball. We don't know what's happening with interest rates any better than anyone else. And, you know, every economist has a view, and pretty much they're all wrong. And we'd be wrong if we had a strong view as well. But what we do is we take positions that allow us to respond to whatever the interest rate landscape is. So for example, when our first Natgen investment trusts were structured in 2021, interest rates were 0.1%. So you add a margin to that and you're paying less than 2% interest for things. But we knew they were going to go up, so we never assumed that that was going to happen. What of course happened is rates increased much faster than anyone predicted, but again that was manageable, and we've managed that situation. We'll continue to do that and take a relatively conservative view on what we expect the average interest rate to be over the entirety of the term of a Natgen investment trust, and that's what we're doing with SG25 as well. So we at Natgen have a small acquisitions and investments team led by myself, and that can be different from many of our competitors and other people in the industry. We often say that a lot of acquisitions are led by the next bonus check coming to the acquisitions manager of some place. The difference in that is that once they get their acquisitions check and move on in a couple of years, they actually don't care what happens. Well, the fact is that God willing, I'm going to be here at the end, and I'm going to have to stand up in front of investors and justify the purchases at the other end of the process. So that makes us quite conservative and very, very careful that we can justify all the decisions that we've made in acquiring a particular asset. And of course, I'm always happy to tell any of our investors what are those issues were when we made that decision, because they're quite transparent. And one of the things about the acquisitions part of this business, it actually benefits, I guess, from experience. So having been doing it as long as I've been doing it, you can kind of tell what the pros and cons are, and you can nearly value it. Of course, once you've done that quick blink valuation, you then have to go and test all the assumptions and do the spreadsheets, all the sort of quantitative analytics. But the qualitative analytics are just like that, which is great. And that gives us the ability to be agile in what we're looking at and to take positions on what we think is coming next. And what we think is coming next is Brisbane, near city, suburban office. Possibly another point of difference for Natgen is our management style during that ownership period. As I mentioned, that's the second tenet of the Natgen investment philosophy, to manage well and actively. So we manage all our assets in-house. Certainly the financial management is done in-house, and most of the practical facilities management is as well. Some of our assets that are a long way from Brisbane, we have local on-the-spot managers as well, but all the strategic decisions and the financial decisions are taken at Natgen head office. So each property we own has basically a business plan done for it. So we can look at what we see the SWOT analysis going forward. We always look at where we're going to be basically at the end. We begin with the end in mind. We have a CapEx plan for each property, and we measure our progress, obviously quantitatively, but also qualitatively against that plan as we go forward. That way we're ready for divestment when those times come. If you would like to find out more about Natgen Investment Trust SG25, I encourage you to fill out an expression of interest form so that you have priority access to the information memorandum when it becomes available. Also, feel free to call Caroline Seymour or another one of the team at Natgen on 1300 100 292, or email us invest@natgen.com.au.